I'm back. Let's go through a few of these drill problems to make sure you understand the concepts that's been covered in chapter 16. First up, prepare a balance sheet. They gave us the following information. They gave us the cash, accounts payable, inventory, capital, and equipment. Okay? So first, you must know the components of a balance sheet, which are your assets, your liabilities, and your stockholders' equity. But you have to know which accounts go up under each of those different categories. So let's begin with our assets section. That's moving fast. Again, assets are things of value that are owned or controlled by a business organization. So cash has value. So does inventory and the equipment account. So you list those under your asset category, get total assets of $74,000. Next, you have your liabilities. This section shows the debts or obligation of a business. The accounts payable account shows money owed to our creditors. It totaled $28,000. And the last section you have is known as owner's equity. This shows the owner's interest into his or her business. Each owner has what's called a capital account that shows the investment made by the owners of the business organization. The owner's capital account has a value of $46,000. Now the balance sheet must do what? It must balance. When you add your liabilities plus owner's equity together, they must equal your total assets, and they do. Both sides total $74,000. You've now prepared your first balance sheet in our course. Congratulations. Next, we're now going to prepare profit margin on net sales. So we said Wilberg invested into a Australia-based franchise $100,000. After finding out the company had gone bankrupt, he rallied 10 other franchises to join him and created a new company. If Rand Auerbach had net income of $38,902 with net sales of $286,585, it's asking what is the profit margin on net sales to the nearest 100%. Okay, so now we would take our net income and divide that by net sales, and that would give us this long number. We're going to round it to the nearest 100%, which would give us 13.57%. So that means that your net income represents 13.57% of your net sales for the accounting period. Want some more? I got you. Find the following ratios: debt to asset ratio, return on equity ratio, and your asset turnover, along with the profit margin on net sale. So you will find the form for all the different ratios or in your textbook and the ebook, or if you have the hard copy as well. So our first ratio says total debt to total assets. We're now comparing the debt of the business, liabilities, against their assets. So the formula is total liabilities divided by total assets, which would give you 87.74%. But how do you interpret that? This is saying that our debt represents 87.74% of our assets. So meaning that almost 88% of our assets were acquired through debt, which is not a good percentage. So we have a high reliance upon debt in order to acquire assets for this actual company. Next up, we have what's called return on equity, which is net income divided by stockholders' equity. This is saying we're looking at the use of equity in order to earn a profit for the business organization. So take your net income divided by your equity, and it gives us 34.43%, which is actually pretty good. So we're saying that by using equity, it resulted in a net income. So 34% of our equity resulted in a profit of $147. Next ratio is called the asset turnover ratio, which is net sales divided by your total assets. This focuses on the use of assets in order to earn sales for the actual business. So you would take the net sales divided by your total assets, and that would give us an asset turnover of 0.13. So what we're saying is that for every dollar we have in assets, 13 cents of that resulted in sales for the actual business. So we focus on the use of assets to produce sales for the business organization. Our last ratio is the profit margin on net sales, which is net income, your net earnings, divided by your net sales. Okay, net income divided by your net sales, which in this case is pretty good. It's 55.47%. So what we're saying here is that our net sales represent a profit. So 55% of our net sales represent a profit for the actual business. So for every $1 in net sales, we earn a profit of roughly 55 cents, which is pretty good. So this shows your net income divided by your net sales. So of course, I'm an accountant. So these type of ratios are analyzed by companies to do comparisons. We'll compare one accounting period against another accounting period. We'll compare our company against our competitor. We'll compare our company against the industry as a whole to see how well are we performing against ourselves, against our competitors, and against the industry as a whole. Last problem, we focused on gross profit, and we went French for this one. We have a French bank reported in 2014 an income of 23,561. Now we're in euros. That's the currency used in the European companies. They have operating expenses of 16,016 euros, and we're asked what is the gross profit. So think about gross profit. If I look at my net income plus my operating expenses, that'll give me my gross profit, because gross profit minus operating expenses gives you net income. So we can, based on the information given, we'll use this formula. The net income was 23 million euros. The expenses were 16 million euros. Therefore, our gross profit was 39,577 million euros. So we can use the information given to calculate the gross profit for the accounting period ending in December of 2014. So this chapter may be a little bit more challenging for you because we're now dealing with accounting. So take your time, review all the lecture information, the supplemental information, learn how to prepare the balance sheet, how to prepare an income statement, and how to use this information to do horizontal analysis, vertical analysis, as well as trend analysis. Okay? Bye-bye.